All right, hello, welcome back to our Rev Kit on SBR. So let's look at this question on group account. Is case study or comprehensive question, 30 marks. Please, if you are going to solve this kind of question, like I will always say, please try and pick this question as maybe the last question that you want to solve. Why? It's a long question. It's going to take a lot of your time and mental strength. So find questions 15, 20 marks that you can solve and get your marks there, then come and sit with this kind of question. Please, as much as possible, unless you are very sure of yourself, don't start with this kind of question because it's going to consume a lot of your time. And if that happens, you might not have as much time as possible to be able to do as much as you need to. Okay, so let's look at it together. Sport PLC is a company which operates in the service sector. Sport PLC has business relationship with Football PLC and Volleyball, so it's like two subsidiaries. The financial position of these companies have been presented, so they give us the statement of financial position, then they give us additional information. On October 2018, Sport PLC acquired 70% of the equity interest of Football PLC. The purchase consideration consisted of cash at 1,460 million. At acquisition, the fair value of the non-controlling interest in Football PLC was 590 million. On October 2018, the fair value of the identifiable net asset acquired was 1,670, and retained earnings were this. The excess in fair value is due to non-depreciable land. That means that due to the acquisition, they had a land that was that had excess fair value. We'll see that when we start consolidating. Okay. Then they give us the same exact information for 80% of equity interest in Volleyball. Okay. Now, both Football PLC and Volleyball were tested for impairment as of September 30, 2020. The recoverable amount of both cash generating units as stated in the individual statement as of September 30, 2020, where Football PLC is 2,850,000 and Volleyball is 1,208,000 respectively. That's the recoverable amount. To compare that with the carrying amount. Okay. The directors of Sports PLC felt that any impairment of assets was due to poor performance of the intangible assets. The recoverable amount has been determined without consideration of liability, which relates to the financing of operations. Okay. Sports PLC acquired a 14% interest in Handball PLC on October 1, 2018 for a cash consideration of 36 million naira. The investment was accounted for under IFRS 9 financial instrument and was designated as fair value through OCI. On April 1, 2020, Sport PLC acquired additional 16% interest in Handball PLC for a cash consideration of 54 million and achieved significant influence. The value of the original 14% investment on April 1, 2020 was 42 million. Handball PLC made profit after tax of 40 million and 60 million for year to September 30, 2019 and 2020 respectively. Okay. On September 2020, they also received a dividend from Handball of how much? 4 million naira, which has been credited to other component of equity. Okay. Sports PLC purchased patent of 20 million to use in a project to develop new products on October 1, 2019. They have completed the investigative phase of the project, incurring an additional cost of 40 million and has determined that the product can be developed profitably. An effective and working prototype was created at the cost of 8 million, and in order to put the product into condition for sale, a further 6 million was spent. Finally, marketing cost of 4 million were incurred. All of the above costs were included in intangible asset of Sports PLC. So they are trying to test IS 38 intangible asset there. Sports PLC intends to dispose of a major line of patent business operation. At the date held for sale criteria were met, the carrying amount of the asset and liability consisting of the line business were PPE, inventory, and current liabilities. Okay. Then it is expected that the Sports PLC will realize 60 million for the business. No adjustments have been made in financial statements in relation to the above decision. Prepare consolidated statement of financial position for Sport PLC Group as at September 30, 2020. So let's take it one step at a time. So let's open Excel. Okay, so alright, let's go. Alright, so we have consolidated statement of financial position. Okay, so please, when you are doing group accounts like this, now please, no matter how complex the question is, you still be able to get and pick some marks because there are some things there that will not require so much calculation or adjustment. So please, no matter how challenging it is, take it one after the other and start doing your answers. Even if you miss one or two, like your final answer is just like maybe 1 or 2 marks, your each step, each one will carry marks. So please, that's why courses like computational courses can really be easy to pass at times, because even if you don't get all the marks, if you can get some things right, you know how to do this part, you can calculate your good, you can calculate your NCI, but you missed intangible assets, you will still get a part of the mark even though you don't have the full mark. And remember, you are going for what, 50%. But let's look at it together. So statement of financial position, let's have two naira figures. Okay, and it should be in million because the question is in what, millions. Okay, so millions. Okay, all right, so let's do it for this one too. All right, millions. Then we are going to do a lot of workings. I'm going to have a lot of workings. Okay, so workings. All right, so let's go. So we start from our assets. We just take our statement of finance just the way it is and we start consolidating. Then anyone we need to adjust for, we make adjustments. That's the best way that I advise you to your what? To do your consolidated financial statement. So anyone that requires working will go and do the working. So let's start. So let's go back to our financials. So what's the first thing we have? The non-current assets. Okay, we have PPE. So property, plant and equipment. So for our PPE, please, of course, like concession, we just add across the face, but we'll now look for other adjustments. So let's add first. So we have 1840 plus for football 600, and then lastly for what? For volleyball is what? 620. So plus 620. And no, before we do that, let's get the percentage ownership in each of them, the control, how much sports has in the other one, and then how much sports through football has in what? Volleyball. But let's still, so this is it, but there's still some one or two other information we'll put this. Let's still leave this for now. Let's go do working. So let's do our what? Okay, so we do our what? Control. Okay, so let's go. So for sports, sorry, control. So for sports has how many in what? In football. Sport in football. Sport in football. Yeah, that one is straightforward. They have 70% if I'm correct. Sport in football. I think they have 70%. Let's confirm. Is that true? Okay, so where are you? Additional information. Okay, they acquired 70% here, so 70%. So that means that they have what? They have control. So 70%. Now, but football now acquired another subsidiary, so like a subsidiary. Football acquired 80% of what? Of volleyball. So football in volleyball. Let's see if they still have significant control or okay. So football control. So they have 80%. So to now determine how much sports has in volleyball, we multiply it. So that would be what? 70% multiplied by 80%. How much would that give us? 70 or 0.7 multiplied by 0. How much would that give us? Let's punch our calculator. This is my calculator. 0.7 multiplied by 0.8, that gives me 0.5. So that 56% what? 56% ownership. That's also significant control. And then NCI will be what? NCI in volleyball will be how much? 44%. We need this is when we start doing some work, some calculation. Okay, so that's 56 and 44 what? Percent. Okay, so let's go. So now, so we're still doing our PPE, right? Okay, so now let's go. Alright, so we've added the 3, right? But we still have some things that we need to also what? We need to take care of. The first thing is, they said they have some non-current assets held for sale, right? Remember that in IFRS 5, we say we classify it separately. So we have to remove it from what? From our NCE, or sorry, our PP, and classify it separately. So let's go and look at, under that held for sale, yeah, they have PP. So remove this 36 million from there. So minus 36, that will appear separately. We write it under our what? Our current asset. So minus 36. Then let's go to additional information 1. They give us some information. It says now On October 1, 2018, Sport PLC acquired 70% of the equity interest of Football. The purchase consideration consisted of cash of 1.460 at acquisition. The fair value of the non-controlling interest in Football PLC was 590 million. Okay. Then they said the excess in fair value is due to non-distribution because they fair value their the NCI using what? Using they said it. I'm coming. Okay, it is good policy to measure the non-controlling at fair value at the date of what? Acquisition. So you have to calculate the fair value of the net asset of both company, which is what? Football and what? And volleyball. So let's start from football. So let's start. So let's have workings one. Okay. Fair value of assets. Fair value of assets for football. Let's just call it football. So of course, like we normally do, we have two dates at what? At acquisition and at what? At reporting dates. Okay, so we have the fair value of the assets. So we have at acquisition date, at reporting date. Sorry, acquisition and at reporting date. All right, let's go. So let's start. So what's the ordinary shares? Let's look at it. So of course, at acquisition, how much did they call it? That will be given in the additional note. So at acquisition says now the fair value of that final was 160 and retained earnings of Football PLC was 638. So they didn't give us any figure about ordinary shares. So assume that has not changed. So it's 800. Let me go and check where are you. So yeah, for football. So you can see the ordinary capital is 800. So we don't have any additional information. So that means we assume that it has not changed. 800. Okay. Next, let's look at what else do we have. We have other components of what? Equity. Other components of equity. For that component of equity, what are the figures that we have there? So as at reporting, we have 74 million. Let's go and check how much do we have as at what? As at coming. Sorry. Where are you? Okay. So the additional notes. Okay. It says retained earnings were 638 million and other component of equity 54 million. So we have 54. So acquisition is 54. Then lastly, we have what? Retained earnings. Retained earnings is how much? Let's check. So our retained earnings given in the question as at acquisition was 638 million. So we'll put that 638. And at reporting date, let's check our financial statement. How much is that for retained earnings for volleyball? That's how much? That's 884. Okay, 884. Now, normally, if we add this up, it should give us the fair value of that. But now they said that if there's any excess, it's because of extra fair value for land. Let's add this up. Okay, now let's check. They also give us the fair value of. Come to this note one. You will see it there now. This question is quite peculiar. Okay, so on October 28th, the fair value of the identifiable net asset was what? 1670. So 1670. So that means it's 1670 as at this date. And at the reporting date, of course, just go to our financials. How much is the total for our equity and ordinary shares? What? That's how much coming. Okay, yes. So what we do is this. We cannot calculate it that way. So let's add this up now. The 3. If we add this up, this will give us 1492. Let me press my calculator here. Please have your calculator with you too. So 1492 minus 1670. That will give me 178. So this 117 is the excess or extra what? Extra land. Let's call it land fair value gain. That's what they told us in the question. So this will add this to the value of our what? Value of our assets 178, and it's going to be the same for this what? This. So let's add this up too. So this will now give us what? 1936. So 1936, 936. Alright, great, beautiful. So let's go. So that's the figures for this. Alright, 1936. So that's that. So let's copy the same thing and go and do for the other one, volleyball. So we do for volleyball, then we now go and finish our NCA. Okay, let's do post acquisition profit to once. So All right, let's do it one. Sorry. All right. All right. So let's do our post acquisition profit. So now that means that if we remove this and this, that will give us our post acquisition profit. Post acquisition profit will now be how much? Post acquisition profit will be my opening minus my closing what? Closing net asset. Sorry, post acquisition profit. Post acquisition profit will be how much? So that will be 1936 minus 1670. So that's 1936 minus 1670. 167. That gives me 200 and what? 266. Okay, so this will give me 266. But please remember that we don't own all. We only have what? How many percent? 70% equity. So all this does not what? Does not belong. Okay, so of course, what we first do is this. Before we look at even the share of the post-action profit. So what we do is this: we less other component of equity, because that one to add an increase. That was, in fact, that was what. So that component of equity, look at it, from 74 to 54 to 74. That means it has increased, and it has increased by how much? By 20. So we remove that because that is not supposed to be part of. That's like, how do I explain that? That's like other comprehensive, because not part of your normal profit. So we remove that. So 240 what? So we have 246. So these are real post acquisition profits. Acquisition what? So is this that will now take, the parent will take what? Sports will take 70% of it, and the NCI will take what? 30%. But we'll do that when we get to that aspect. Okay, so that's clear for this. Okay, so let's go. So let's do it for this too. So let's go and calculate the figures for volleyball. So for volleyball now, what we have is that ordinary shares is how much? Let's check. For volleyball, ordinary shares is 400, 450 to 78. So let's add that 450 and 278. Okay, so let's go. Then for this is going to be how much? Okay, ordinary share capital. Sorry, let's go and check additional information for that as at acquisition. Okay, all right. So it says the fair value of Okay, at the date of acquisition, the fair value of the identifiable net assets was 724. Retained earnings was 212. So this is, so the 400 will still be the same. So retained earning was what? 212. It was 212. Another component of equity was how much? Another component of equity was 40 million. The excess is in what? Non-depreciable land again. So this will be what? This will be now 40 million. So this will be 40. Okay, so let's go. So then so we have done retained earnings, right? So let's add it up. So how much is it supposed to be? The fair value of the net asset is how much? 724. So let's remove. So 724. So let's now add this 3. Without this is, let's remove this source from the other one. So this gives us 652. 724 minus 652 give us how much? 724 minus 652. That gives me 72. So 72. So 72. So that gives me 74. So then I'll add my 72 here too. 72, which is the land fair value gain. Okay. So let's add. That will give me how much? That will give me 800. Just give me 800. Okay. So let's go. So that means that my post acquisition is 800 minus 724, which will give me how much? 76. But like for the other one, so I will have to remove the less other component of equity, which is what? 50 minus 40. This around is what? Is minus 10. So that we have how much left? 66. This is what they also share between the what? The parent and NCI. Okay, so that's that. So what are our figures that we need? Land fairly 72 and what? 170. So we add it to our what? Non-current assets. 72 and what? 178. All right, let's go and do that. So plus 72 plus 178. Okay, so if you punch your calculators and you calculate that, that will give you 3274. Okay, so let's go. That's our PPE. Okay, next, okay, let's put it here. We still have other figures to calculate, then we'll bring the total to the other side. So next, all right, so then let's look at what we look at the next one, which is what? Which is The next thing we're going to calculate is what? We're going to look at let's go back to our alright, so statement of financial position. Next is what? Investment in subsidiary. So investment in football is 1,460. But please remember that we're not going to include that because we are consolidating. Do you get? That will not be captured. We'll capture it under when we are treating our equity. So it will not be captured because we are consolidating now. You won't put investments there. Volleyball too, we are not going to put there. The only one we are going to put there is they told us they acquired something in another company entirely. This is the third. Okay? No. There's another one again that they told us they acquired this. Okay. Then Sports PLC acquired a 14% interest in Handball PLC. So that's like an associate. So investment in what? Investment in Handball. So we'll go and do a small note for that. So let's calculate our investment in Handball. So let's go. So this is for volleyball. Volleyball. Alright, so investment, that's working stream. Investment in what? Investment in Handball. Let's go and calculate the value of the investment so we can put it in our what? We can put it in our books. So for investment in Handball, the first thing we are going to look at is, let's go. So initial time when they acquired it initially, the cash consideration was what? So we start from that. So you know how you do your associate now. So you have your cash consideration 36 million. Okay, then what else do we have? Let's now check. So they said they accounted for it on IFRS 9. That's fair value through OCI. So any movement in the fair value will go to our what? OCI. So let's go. So this is as at October 1, 2018. If you read down, they said the value of the original 14% investment on April 1, 2020, which is 2 years after, is now 42 million. So that means it has increased from 42 to 36. So we'll capture the increase in what? In fair value. So increase in fair value, which is what? 42 minus 36. 42 minus 36, that will give me how much? That will give me 6. Okay, so alright, great. So if I add it, that will give me, that means ordinary is 42. But let's continue. They have what? Another additional investment. They said they bought additional share again. Okay, on 1st April 2020 again, Sport PLC acquired additional 16% interest in Handball PLC for what? For cash what? For cash consideration of 54 million naira. So 16. So additional cash consideration. That's how much. That's, let's say additional cash consideration is 54 million. So 54 million. Okay, so it's like 54 million. All right, then let's add up. So how much is our total investment in it? We have how much? 96. So we have spent 96 so far. Then have we gotten any dividend, or is there anything that we need to get? Share of profit or dividend? So let's go. Did they make any profit? Okay, so let's look at it. So so they said yes. Handball PLC made profit after tax of 40 million and 60 million for 2019 and 20. We are doing for 2020, so we need the 60 million. So we are going to pick our share. So 60 million share of profit. Share of profit is 60 million. Okay, then multiply by, now let's calculate our total holdings. We had 14% before, we now bought 16%. That makes it what? That means we have 30%. So we have 30% of that. But please, let's go. When did we get up to 30%? We got up to, the additional one we bought was on April 1, 2020. And the profit is for up to September. So we cannot do for a full year because we got the share. So they'll give us for April 1, May, June, July, August, September, 6 months. So we have to prorate that profit, multiply by 6 over 12 because we can't take everything, because we acquired this up to 30% as at what? As at April. So let's do this. So 60 multiplied by 30% divided by 6 over 12 will give me what? 9. You can confirm that. Please place your calculator. Then lastly, dividend paid. Yes, they paid us dividend. We have to remove that to get to the value of our investment left. So, and they said they received dividend of 4 million. Okay, so 4 million. So minus 4, we'll remove that. So that will give us the value of what? Our investment. So it's now what? 101. Okay, so 101. All right, great. 101. All right, so 101. So let's go. So we have 101. So this is 101. All right, let's continue. What else do we have in our statement of financial position? Let's keep consolidating. So it's better to just take it one by one like that. So we've done investment in handball, right? The next is what? Our intangible asset. Okay. So intangible assets. We have to do some adjustment here. So intangible asset, let's go and pick our figures first. We have 396 plus 60 plus 70. So 396 plus 60 plus 70. All right. 396 plus 60 plus 70. We have to make some adjustments. One, they told us that there is a particular impairment. So we have to go and calculate our impairment. Then we also were told that there's this note on development or something like that. So let's go and check it out. Okay, so let's start from, let's look at the development first now. Sport PLC purchased patent of 20 million to use in a project to develop new products on October 1, 29. So the 20 million will be what? To be classified as intangible. Sport PLC has completed the investigative phase of the project, incurring an additional cost of 14 million. Please, that initial 14 million is just for the investigative phase. You are not supposed to classify it as part of your intangible. So we are going to remove it from our intangible because they have already added it. Is not right. Okay. All right. Then they said finally marketing cost of 4 million were also incurred. That is not also what? Allowable because it's just marketing cost. Okay. So 14 plus 4. Okay. Then all this effective working prototype 8 million. And then in order to put it, we have further 6 million was spent. This one is still what? Development cost is what? Is capitalized. But please, any money spent on research phase is what? Is expensed. Okay. So this 14 million and this 4 million on what? On marketing will be what? Will be expense. So that's what? That's so minus 18. We are going to derecognize that. That's the whole essence of that additional information. I wanted to test IES what? 38. Then we still need to calculate our what? Our impairment. Because let's go to this note. There's this note they give us on impairment. That's note 3. Both football PLC and volleyball PLC were tested for impairment as at September 30, 2020. The recoverable amount of both cash generating unit as stated in individual statements as September 30, 2020, where football PLC is 2,850 and volleyball is what? 1.208 million respectively. So the director of sports PLC felt that any impairment of asset was due to poor performance of what? Intangible assets. So whatever impairment we calculate, remember IS 36 on impairment, we first take this, we use it to hit our goodwill first, then the leftover will go to our what? Will go to our intangible assets. So that means we need to calculate two things. We need to calculate our goodwill to know how much goodwill is for both football and that's volleyball. Then we also need to calculate what? The total impairment. So we can now allocate it accordingly. So let's start from calculating goodwill then. So let's go and calculate goodwill. You know how to calculate our goodwill, right? Let's run over it together again. So goodwill. So let's go and calculate our goodwill. So to calculate our goodwill, of course, what we do is that we start from our what? Consideration. So that's note 3, right? Goodwill. Note 3. Note 3 is on goodwill. So goodwill of, let's start for football. We'll calculate it separately. Goodwill of football PLC. Football PLC. Okay. So for goodwill of football, what are we going to do? So we start from our purchase consideration. We now less the what? The fair value of the what? Of the NC. We add NCI fair value, then we remove what? Fair value of net asset at acquisition to get our goodwill. It's as simple as that. So our purchase consideration is how much? Let's go and check. That was given in the question. So for football, how much did we pay? So that's in note 1, football. So for football, we paid what? We paid 1,460. So 1,460. This is in millions. 1,460. That's our purchase consideration. Then we add the fair value of our what? NCI. That's been given in the question. So they told us that already. Let's check it again. The fair value of NCI is what? 1,670,000. No, sorry. Fair value of NCI come down as at acquisition. Okay, no, I'm coming. The fair value of the identifiable net assets. Okay, this is net asset, not NCI. So that means that we have to calculate NCI before we can calculate fair value of what? Fair value of our what? The fair value of NCI, I'm coming.
me a minute. They gave us now. What am I saying? The fair value of the share is just that the fair value of non-controlling interest in football PLC was 590 million. So they gave us, so we have it here. So we have 590. Okay, so let's add 1460 plus 590 will give us what, 2050. Okay, remove that from what, the fair value of the net asset at acquisition. Fair value of net asset at acquisition date. That will give us how much? So our fair value of net asset acquisition date, let's check. We're also giving you the question. That's 1670. So minus 1670. So how much is our goodwill? So our goodwill is how much? Goodwill is 380. Okay. So and for this we don't have any impairment because they told us that that's impair. Okay, no, let me not jump. Okay, so let's go and do for goodwill of volleyball. Same thing we did, goodwill of volleyball. Okay, so to calculate the goodwill of volleyball, what do? We have what? First, purchase consideration. Our purchase consideration for volleyball is how much? That's the second note, 640 million. So 640. All right, let's go. So after our purchase consideration, please, for volleyball, you know it's different. It's like a subsidiary. And remember that how many did we acquire? We acquired 70%. Okay, it says now football acquired 8% of the equity interest of volleyball for cash consideration. The fair value of 20% holding of the non-controlling was 40 million, and the 30% holding was 216, and 44% was 322 million naira. Okay, so now remember that for our parents, they have what? We have only 70%, but the whole of football acquired volleyball. That means that out of this volleyball that we acquired, 30% does not belong to us. 30% of the 80% that we bought does not belong to us because it's not a total company, it's not a fully owned subsidiary. We have to put, so we have the indirect holding, that is the one that belongs to NCI of what? Of Sport PLC. So we have to remove that. So indirect holding, that's how you calculate that. Indirect holding, one that does not belong to, which is 30% multiplied by what? The 640 that we paid. That one is not our own because we only own 70% in football. So 30% multiplied by 640, if you put your calculator, that will give you 192. All right, then you have your fair value of what? Fair value of NCI. We're giving that to in the question. So let's take note 2. The fair value of remember I told you we did 44%, right? 56%, and NCI is what? 44. So fair value of the NCI you look for is what? The one that is 44%, which is what? 322 million. So please be very careful. 322 million. All right, so let's add up. So how much is the total that we have? We have what? 770. Then we remove it from our what? Fair value of net asset acquired. Net asset at acquisition. We're also giving that in the question. How much is that? Net asset at acquisition is how much? 724. At date of acquisition, the fair value of the fair net asset of volleyball is 724 million. So we have minus 724. That'll give us our goodwill. That'll give me what? So that's my goodwill is what? 46. So my goodwill for volleyball is what? 46. So goodwill of volleyball, all right, is what? Is 46. Or I'm just not it. All right, so let me not even do it because we might still need to do one or two. Let's now go and calculate our impairment. Then we know which of the two the impairment is affecting, so we can now to allocate it. So impairment now. But before we can calculate our impairment, we are given a recoverable amount. We have to determine our carrying amount first, then compare that with our recoverable amount. Remember our year is what? IAS 36, and that's what will give us what? Impairment. So carrying amount we have to do for both football and volleyball. Let's get the carrying amount of the net asset. Okay, so so it says now, so let's go. So we pick it from our what? Statement of financial position. Okay, so let's go. So we have what's the total asset we have for? So total asset is 2260 here for football. So let's start from that. Total asset is what? 2260. Okay, for volleyball is how much? Volleyball is 1190. Okay, the Remember that we had some additional assets that we acquired. That fair value of land that we gained, we have to add that. That's also an asset. So for this is 178 that we calculated, and for this is 72. Then lastly, do we have goodwill? Sorry, do you have goodwill itself? The question before, let's check. All right, yes. So we calculated goodwill. Goodwill is going to be part to goodwill. So goodwill, we said 380 for this and then 46 for this. So let's add it. So how much is the carrying amount of the what? Of the asset or the cash generating unit? So let's add it up. This give me what? 2818. So 2818. And if I add this up, this will give me how much? This will give me 1308. So 1308. All right, no problem. So that's that. Then if we have that, then what else are we going to do? So that's our goodwill. Okay, so then we now compare it to what our recoverable amount, whether it has been impaired or not. So recoverable amount. So what's our recoverable amount given in the question? So recoverable amount for note 3. All right, so football is 2,850. So 2,850. Okay, and then for volleyball is 1,208 or 1,208,000. So let's compare. You can see that our carrying amount is, for this one, carrying amount is less than recoverable amount, so there's no impairment because our carrying amount is even less, so there's nothing to impair. But if you check for this one, look at your carrying amount is more than your recoverable amount, so you have to account for what? Impairment. So 138 minus 128, impairment will be what? 100 for this. Then the other one will not have any what? Impairment. So I've calculated impairment as what? Impairment as 100. Let's now allocate the impairment allocation, just like we did in IS 36. And remember that it's only volleyball that has. So the first thing is what? Total impairment. Total is how much? Total impairment is 100. Then, of course, we need to read our goodwill first. Then there's the remainder that will now take to whatever asset. So goodwill is how much? 46. So the whole of our goodwill will disappear for this because it has been what? Impaired. So 100 minus 46 will give us what? 54. So this 54 is what we take to our what? Intangible asset, because we're told that it's intangible asset that it affects. So 56. So minus 56. So that's how we allocate it. So that means that our goodwill for this is exhausted. So but for intangible, we're now going to remove 56. So let's go back to our statement of financial position. So what's our intangible? Intangible is also this. Then so minus what? Minus 56 minus 6. Okay, let's press our calculator. What will that give us? Okay, so all right, press our calculator. So we have 396 plus 60 plus 70 minus 80 minus 56. That's going to give us what? That will give us what? 452. No, sorry, let me do this. No, this should be 54. Sorry, because that other one is, let's go back. So 46 minus 100 will give us 54. Let me check. 46 minus 100 will give us 54. Now, not. I'm coming. Where are you? Sorry, 54. This should be minus 54. So let's do it again. Okay, so let's go back. So if you punch our calculators, so it's going to give us how much? Alright, so let's do it again. So minus 54. That'll give us 454. Alright, great. So next, let's go back to our SFP. What other things do we have there? Alright, so investment. We've done it tangible. Please, we are going to add goodwill to it. Alright. So goodwill. Alright, so goodwill. That was just calculated. Thank God we have calculated it. We said there's no more goodwill for the other one, but for the football, the goodwill is what? 380. So let's have our total non-current assets. It's going to give us what? 4,209. So let's put that here. 4,209. Let's continue. So let's now have our current assets. We are like around 40% done. Current assets. As I said, this kind of question will take a lot of time in the exam. So for our current assets, let's go to SFP and start adding up them if you need to do any adjustment. So for our current assets, we have what? Where are you? Current assets is 1,7 1790, 960, and 500. But remember that we have a particular one that we classified under what? NCA held for sale. So we have to remove that part. So let's do the addition. So 1790 plus 960. So we have current assets 1790 plus 960 plus 500. Okay, then minus, let's go to our note that note on, where are you, the held for sale. Okay, so inventory is 98 and that's the current asset, so minus 98. We have to remove that portion. Minus 98, that will give us how much? Let's add. So 1790 plus 960 plus 500 minus 98. That gives me 3,152. So 3,152, 152. All right. So that's we've captured that 3,152. Then the next we have discontinued operations. Discontinued operations. I told you have to classify that separately. That one is very simple. Let's just go and pick our figure straight up. So we have two assets and one inventory. So we add it and remove the liability. Sorry. 36 plus 98 minus what? Minus 6. So 36 plus 98 minus what? Minus 6. How much would that give me? So let me press my calculator. 36 plus 98 minus 6. That gives me 120. No, that's not. Sorry, is it 6? Let me check. Oh, sorry, I can't put liability. There's also impairment. Please, there's impairment on this. Remember that if you want to calculate our FIS 5 too, remember our standard says that we compare our carrying amount with our fair value less cost to sell. Okay, so let's add. So 36 plus 98. Okay, then that will give us what? 134. So minus 6 will give us 128. Then minus 60, because they said they can only sell it for 60. If the carrying amount is 128 and we can only sell for 60, that means we have impairment of how much? 68. So remove that impairment. So minus 68 here. So minus 68. That's impairment. So let's go. So 36 plus 96 minus 68. That gives me what? 64. So 64 will be here. 64. Oh, no, I'm coming. Let me do it again. 36 plus 98. It's my figures correct. I'm coming. 36 plus 98 plus 6 minus 60. That's 80. 80 minus, no, sorry. 36 plus 98. Yeah, 36 plus 98 minus 6. That gives me 128 minus 60. That gives me 68. So 36 plus 98 minus 68. That gives me 66. Okay, so I have 66. All right, let's go. All right, so let's look at that's our addition. So let's add it up and get our total asset. So we have how much here? 3,218. So 3,218. So let's add it to this. If we add it to this, how much is our total asset? Then we'll go to our non-current liabilities and liabilities. So that will give me what? 7,427. 7,427. All right, so sorry, 7,427. All right, so let's go. So all right, so that's that. So this is my total asset. So let's now go and do my what? Liabilities. Total asset. So equity and liability now. Equity and liability. Equity and liability. So let's go. So let's start from equity and so let's start from our equity. Equity is quite simple. Of course, you know that in our consolidation we only pick the equity of our what? Of our parent. So let's go. How much is the equity of our parent in our financials? Please only pick equity of your parent. But for other component and retained earnings, we'll do calculation for. So equity of our parent is what? Ordinary share capital is what? Sorry, I said equity. Ordinary share capital. Under equity, we have what? Ordinary share capital. Only pick the ordinary share capital of the parent. Ordinary share capital is how much? That's how much? That's 1,000 what? 1,840. All right, correct. 1,840. Okay. So let's go. That's ordinary share capital. Let's go. What else do we have? Ordinary share capital. After ordinary share capital, we have other component of equity. Component of equity. Let's go and calculate that. We have to do a small note for that. So that's the next calculation we do. Other component of what? Equity. What's making up our other component of equity? Other component of equity. Alright, so let's go. That should be note what? Note 5 or something like that. Alright, so it should be note 4. Other component of equity. Component of equity. Alright, so let's go. So let's go and start. So then the first thing we have is what? Other component of equity of the parent. So that one we other component of parent. That one will come in fully. Parent. How much is that? Let's go and pick for parent. That's 146. 146. Then we now had what? Remember that we said there was a fair value gain in what? In our acquiring and ball. Let's check it. That one that we did 42 minus 36. Remember? So but now we are going to no. So we are going to do. We are going to remove fair value gain on what? On handball. On handball. Okay, because it's not supposed to be part of it too. That's how much we call it 6 the other time. So minus 6, it will come here. The fair value we gained on our what? On our subsidiary. We do it in. Is this like your OCI? Okay. Then of course we have dividend paid by handball. That also has to be captured. This is like your statement of changes in equity. Dividend paid by handball. We also remove that handball. Okay. So how much dividend? I think they said 4 million. Let's check. Let's confirm. Yeah, so on September 24th, you received the 4 million. So minus 4 million. Minus 4 million. Then we have share of what? Share of post-acquisition OCE. Remember that we said our OCE. Remember when we were doing our calculation, I'll go back there now. When we did OCE football. OCE for football. Okay. Football. So let's go. Remember we said this, that 74 minus 54 that we did, that was the difference. Where are you? Yeah, this is it. So this is this 20. So we are going to take the parts that belongs to the parent, and we have 70%. So that will be 70% of what? 20. 70% multiplied by 20. That will be the part that goes to our own other component of what? Equity. So 70% of 20 will give us how much? 0.7 times 20. 0.7 multiplied by 20. That give me 14. So that's 14. Okay. 0.7. That'll give me 14. Then what else do we have? Share of production OCE football 70 times 20. That'll give me that. Then we also have what? Share in volleyball. Share of post-acquisition OCE volleyball volley. Okay, so but we have only 56% in volley. Remember that it was what? And this time around is 10 that we got. So 50% of 10 belongs to us. So let's go. So how much is that? 0.56 multiplied by 10. It gives me what? 5.6. So that 5.6 belongs to us. So let's add up. So this is what makes up our what? Our other component of equity. So that gives us what? 155.6. So that's the value. 155.6. Okay. So let's go 155.6. Let's go and put that there. 155.6. Where are you? 155.6. So let's go back to our equity. I think the next thing is our retained earnings. Yes, we have retained earnings. Let's go back to our SFP. Yes, we have retained earnings. So we have to do workings for that too. We have to do some adjustments. Retained earnings. So retained earnings. So retained earnings is going to be how much? Let's go. So we have retained earnings first for our what? Our where are you? So let's calculate retained earnings of the parent. So let's do additional for that. So now we'll start from parents with retained earnings. Okay, so let's go. So let's go and do a workings for that or a note for that. So let's assume it's 5. Group retained earnings. Retained earnings. Alright, so we'll start from our parents retained earnings. We pick the whole figure, then we now start sharing our own portion of the profits that we got from all. So our share of that's how much retained earnings of parents is 1790. 1790. Alright. Then we have what? Of course, remember we have impairment loss. Remember, so we have to take our share of it as parent in the subsidiary, and our share is what we have. Remember that 40 what 40, I can't remember the result. Let me check. Let's check. 40, what did we take to impairment? Let's check where you, okay, so 54 went to impairment and 46 is coming to our what 46 is coming to, okay, 46 went to goodwill and this intangible assets, so we have to take our portion of it. So we do what? So share of what? Impairment loss. Share of impairment loss. Share of impairment loss. That will be how much? That will be 56%, which is our own portion, multiplied by what? Multiplied by 56 that goes to our intangible. So if you press your calculator, sorry, share of impairment loss, the group we take, because we are using fair what's the name of this? We are using the fair value of net assets acquired, or we are favouring NCI. That's what I wanted to look for. Please, we are going to take 100% of the worth of the impairment. Is going to go to the parent. Okay, so how much is that? That will give me minus 56. So the only impairment will go to the parent, or the group retained earnings. Let me use it that way. The retained earnings of the group. Parents will take it. Okay, so then let's go. So then we have what? Share of profit now. Share of post acquisition profit. Post acquisition profit. Post acquisition profit. Okay. Okay, wait. Share of profit, I'm coming. Let me check. We have football, we have volleyball and handball, right? Great. So let's start from, which one should we start from? Let's go. Let's go. Okay, so let's start from our which one should we start from? Let's start from handball. Okay, so share of profit from handball. So that one is not post action. So how much was their total profit? Remember, it's 60%. We've done it before. So it's 60 million multiplied by what? We said we had what? We had 30% stake. Okay, then multiply by what? Multiply by 6 divided by 2. I've already calculated it that time and give us what? 9 million. That belongs to the parent. Okay, then share of what? Post acquisition football. Post acquisition for football. So we said post acquisition for football is 246. Let's go and check how much did we calculate for football. Okay, so post acquisition for football, sorry, let's go and look for football. Football, where are you? Post acquisition for football. Okay, 246. So we share that 246. So of course, to share that 246 is going to be how much? 246 multiplied by what? We have 70% stake. So 246 multiplied by 70%. 246 multiplied by 0.7. If you press your calculator, that will give you 172.2. Okay, then share of post acquisition in what? In the other company, which is what? Volleyball. So that one we got how much? We got remember we got 66. So 66 multiplied by 0.56, which is our what? Our percentage holding in that, which is 36 point what? 36.96. Okay, so then we are going to accommodate all our other impairments. Remember that we added back this intangible assets. So intangible assets added back to expenses. The 18 that we added, that they were not supposed to capitalize, so we do it minus 18. That to be removed from our retained earnings or our profits. Then impairment on discontinued operation. I hope you remember that too. Impairment on discontinued operation. I said it's 68. We calculated it together. 68 minus 68. Okay, so that's all. So let's add up. How much is that going to give us? Okay, let's add. So that will give us how much? So if we add, that will give me 1,000 what? 866. I'm coming on 796. 56. This should be 54, not 56. Sorry, 54, not 56. Okay, so let's check. So how much is that going to give us? That's going to give me how much? That will give me 1868 if you round it up. Okay, so 1,068. That's what? That's my retained earnings for the what? For the parent. So let's go and do it. Then we'll now calculate our NCI. 1868. So that's 1,868. 1868. So let's do that. Then we, of course, lastly we calculate our what? We calculate our NCI. Okay, so then NCI. So to calculate our NCI, let's go and do our NCI for each of them. NCI in football, NCI in what? In volleyball too. Okay. Alright, so 6, which is what? NCI. Okay. So we start from fair value of NCI and then adjust for any impairments and share of profit that NCI has. So let's start from NCI for football. NCI for football. So let's do for NCI for football will be how much? Let's go. So we have fair value of NCI. That's where we start from. So what's the fair value of the NCI for football that we're given? So let's check. That's note 1. Okay. The fair value of NCI is what? 590. So we start from that 590. Okay. 590. All right. Then their share of what? They take their share of that OCE at post-acquisition that we calculated. So I remember we said the OCE is how much? 20. Okay. But they have 30%. So they will take 30% of the what? 30% of the 20. 30% multiplied by the 20. Okay. 0.3 multiplied by 2 give us how much? 0.3 multiplied by 2, 20. Okay. Sorry, 30 no, sorry, 0.3 multiplied by 20. Yeah, that's it. So that's 6. So that will be 6. Then their what? Their share of what? Share of, they don't have any impairment. There's the other one that they have impairment in volleyball. So share of post-acquisition profit. Acquisition profit. So how much is their share of post-acquisition profit? Post-acquisition profit is what? 246. And they get what? 30% of that. So 30%. If you punch your calculator, please confirm. That will give you. So if you do 30, that will give you what? 73.8. 73.8. Alright, great. So let's continue. Then let's add up. So 590 plus 6 plus 73.8 will give me how much? 669.8. So that's for this one. Then let's go and do for the other one, which is what? Volleyball. So NCI volleyball. So let's change it into NCI volleyball. So for volleyball is how much? So fair value of NCI for volleyball is, let's check note 2. Where are you? The fair value of 44% is how much? 322 million. 322 million. I remember that we don't have, so we have to also remove that indirect holding that we did the other time. I've explained that. But portion that does not belong to us, which is what? Which is 30% of that 640. So 30% multiplied by the 640 million, which we paid. That's how much? Minus 192. Okay. Then we now start doing the share of, and then we add the impairment loss. So let's start from share of post-acquisition. Okay. Profit. Let's start from there. So share of this time around is 66. Abi? Yeah. 66 multiplied by what? Multiplied by 44%. Okay. 66 multiplied by 44%. 44%. That will give us how much? 61.44%. If you punch your calculator, that will give you 29.04. Okay. So let's have. Then we are not done. Okay. Then we have what? We have share of OCE. This time around is 10. Remember, it's 10 for the subsidiary. Multiplied by what? Multiplied by 44%. 10 of 44%. They will also take that part. 44%. Okay, 44%. That will give me what? Of course, that will give me 4.4. Okay. Then I have to do my what? My share of impairment loss on that intangible asset. Remember, they have to take impairment loss on intangible asset. That means they are taking the 100% of the what? Of the one that we took to goodwill. So that's going to be how much? 100% multiplied by what? Multiplied by 44, which is 44 or 46? 44. Is it 44 or 46? Let me confirm. Sorry, I used to mix that figure up. 44 or 46? Where are you? Okay, 46, not 44. 100% multiplied by 46. Okay, 46. Okay, how much is that going to give us? That will give us what? That will give us 46. Okay, all right. 46 minus 46. No, 44. I'm coming. Let me go and confirm that. It's really confusing. Minus 44. I'm coming. So I'll confirm that. So then let's add up. How much is that going to give us? That will give us what? 119.44. So 119.44. Okay. Then go and confirm that impairment loss that we calculated. If you calculate it well, intangible is how much their so the allocation So remember the goodwill for this is 46 and this is 46. So 46 should actually go to goodwill and 54 should go to okay, so that means I've made an error. So the other ones I've calculated. Where is it? Where is the 54? So this should be 56. You understand? 50. It will still be the same thing because that two will negate each other. But please, this should be 50. Let's do it right. Let's now assume 50. This should be 56 minus 56. So let's re-add it now, and then we'll go and turn that one to 44. So this will give me what? 1866. Okay, 1866. And then this will give me 40. This will be minus 46. Sorry, minus 46. That will give me what? Let me do that. Minus 46 will give me what? That will give me 117.44. So 117.44. Okay, did I do it right? I'm coming 117.44. Alright, so let's go back up. What do we have here? 46 and 54. This should be 54 now. What am I doing? Don't mind me. This will be 54 and that should be 46. So let's do it again. 54 and 46. So if we add it up, it gives me what? 1868. This is correct. This should be 1868. Then this should be what? This should be 54. This should be 40. What did I do there now? That's 54. Right? This is 46. Okay. So this should give me 117.44. So let's have that. It's 117.44. 117.44. Alright. So 117.44. Let's go and add our NCI together now. So to get our NCI in our statement of financial position will be what? 66. What's the NCI for that? We'll go for the first one. So yeah, my group retained earnings will change. Let me go and change it. Is this the 1868? Let me check. Is that still correct? Group retained earnings is 1868. Yes, that's still correct. So NCI. So NCI that we got now. Let's go and look at it. So we got. Where's the figure now? So we got 669.8 plus what? Plus 117.4. 669.8 plus 117.4. 669.8 plus 117.4. 669.8 plus 117.4. Okay, that will give me how much? Let me add 669.8. 669.8 plus 117.4. That gives me 787.2. Okay, 787.2. 77.2. Yeah, let's add up. So how much is our equity? Then we'll now go and do our liability and we'll round up. Okay, so you can see it's quite a long. That's why I say you don't start with this kind of question, please. 4651. So 4651. Okay, so let's go. Okay, next we now have what? We have our liabilities. Liabilities. So we start from non-current. That one does not have so much adjustment because we're not giving so much non-current liability. Do you have any non-current liability given in the question? Let's go to our SFP. Yeah, we have. So we just add. We don't have any additional information. This is a free mark. So 990. So let's add 990 plus 990 plus. Okay. So we have 246 plus 186. If you add up, it will give you 1,422. 1,422. 1,422. Okay, so that's for our non-current liability. So we now have our current liability. Okay, let's just take this here. Current liability now. Current liability will be how much? Let's go. So for our current liability is 816,256 and 276. So current liability we have 816 plus 256 plus 276 minus 6. Okay, that'll give me how much? So please remember that this 6 is the non-current asset held for sale, the liability part. So that will give me 1,422. Okay, then I'll now take it outside. So we have what? Discontinued operation. It will now appear separately. Discontinued operation. discontinued operation. So that's going to give me how much? 6. So let's add it. So 1422 plus 6 will give me how much? 1428. No, sorry, this should give me 1342. Sorry, 1342. All right, 1342 plus 6 will give me what? That will give me 1348. 1348. So 1348, let's add the right from equity up to this. That gives me what? That's 7,421. Okay, as if I knew 7,421. It's not balancing. Let me check. I know it's that pyramid that is giving me issue. So 7421, 7427 minus, that will give me 6. So I don't know why I'm missing that 3, but please, it's not what's going on. So please, I'll check and maybe I'll just get back to you on if I find. I don't want to, because the video is already very long. So please take this question, solve on your own again. Don't assume you have known it until you solve it on your own. All right, thank you.